Hi, everyone. I wanted to share a couple things that I noticed as I was taking a look at Gap's earnings that were reported last week. Gap actually beat on both their sales and earnings, but they added a fair amount of detail surrounding the costs that they expect to face because of tariffs. In their press release materials, they specifically reference they expect to be facing 250 to 300 million in tariff-related increased expenses in the remainder of the year. They added that they expect to mitigate this risk to bring that number down to between 100 and 150 million. And with that, they did mention what their expectations were for annual sales and margin, but that margin that they mentioned was lower than analysts' expectations. Analysts expected that gross margins would be 42.5% on the year, but their outlook is only 41.8. So their stock took a beating. I believe it's down a little over 20% since last week. But something that I noticed that is even more alarming is that in the fine print of their materials, it specifically states that these figures do not reflect any of the tariff-related cost increases. So it seems that if any automated trading software is pulling out the metrics from their press release, they will be assuming a gross margin of 41.8 for their valuation of Gap, when in fact that does not reflect these increased costs of tariffs, which could be up to a 2 percentage point further drop in their gross margin. It's likely that some of this incremental risk has been reflected in their current stock price, but it seems that there might be more risk in their business model as well related to tariffs. What do you think?